The dollar is on a tear, having advanced by 2.1% in April on a DXY basis, the largest one-month increase since November 2016 when Donald Trump won the US presidential election. Similar to back then, however, we doubt this jump is a signal of a sustained move stronger for the dollar through the remainder of this year. The key driver of this dollar strength has been the flow of economic data, which has been viewed as more resilient in the US than in key countries abroad, like the Eurozone and the UK. While speculation of Fed rate hikes crept higher during April, expectations in many countries outside of the US reversed. Growth concerns have curtailed investors' appetite for non-dollar portfolio assets. Data from the ECB confirmed that foreign investors were net sellers of Eurozone equities in February for the first time since October 2016. In addition, fears of a global trade war and a 3% 10-year US Treasury bond yield have impacted appetite for investments in emerging markets. Our Asian Equity Flow Index shows net selling resumed toward the end of March, after 20 months of net inflows. However, these fears of a global trade war are now receding. A newly negotiated NAFTA deal appears very close, while the US and China are about to begin negotiations on changes to their trading relationship. Furthermore, in a sign that the US administration does not wish to spark a trade war, President Trump confirmed a further extension to the exemptions to the steel and aluminium tariffs that was granted to allies of the US. As global trade war fears recede, we would expect to see flows into non-dollar portfolio assets pick up, helping to weaken the US dollar again. But there is no getting away from the fact that the Trump administration wants to reduce its trade deficit with the rest of the world. This can only ever be done in three ways. First, the US saves more and spends less. That looks very unlikely following the unfunded $1.5 trillion tax cut. Second, the US curtails capital inflows that currently finance their trade deficit. That's also very unlikely, given how the US values the US dollar's reserve currency status. Or third, the US tries to devalue the dollar. With President Trump recently complaining about China and Russia playing the currency devaluation game, global investors will likely view this third option as the most plausible for President Trump to pursue in achieving his trade policy objective. We believe this risk and a renewed pickup in global growth will limit demand for the dollar and leaves us convinced that this dollar upturn will prove unsustained.